It's really intriguing for me to be up here talking about Japan. When I was asked to make this presentation, it recalled something that happened many, many years ago, and I will put it, and I'm going to really disclose a little about me, but I was 17 years old, and I was in my first year of university in a small liberal arts school in New England. And I am from Long Island outside of New York, and by that time I had never been further from my home than Washington, D.C. And it turns out that one of my new classmates was from Japan. He had never been to the United States, and he was coming over here to go to school for 4 years. And to me, 17-year-old kid who really was naive and very young, and I've only taken care of one of those things, by the way. I said to him, Kikuchi, do they make cars in Japan? And Kikuchi was very patient, and he said, yes, we make cars in Japan. And about 5 years later, thanks to my Uncle Sam, I found myself stationed in Japan, and I became aware that they made cars, and they made a lot of things, and I became extraordinarily impressed. I had the good fortune, and I even think the honor, to attend the Olympics in Tokyo, and I fell in love with Japan, and I have been ever since. And I've been to Japan a number of times. And in my banking career, which ended about 12 years ago, I actually worked for the New York branch of one of the large mega Japanese banks for 8 years. So I've been to Japan a number of times, and not just in a dispassionate way, but also with an awful lot of affection. And it was somewhat unsettling to me to watch the bursting of the bubble in '89 and I guess you could say, the problems that existed in Japan, and the fact that to a certain extent, Japan disappeared from a lot of people's mindset and somewhat became either invisible or irrelevant. And I think that that's not accurate, and I think that it is something that we should look at again. The question here is this the time to invest in Japan? And that's one of those questions that's difficult to answer. I remember in my work, I actually, unfortunately, was responsible for foreclosing on a number of properties. This is a very cyclical industry. I'm not telling you something you don't know. But in one of the properties that I had foreclosed, I sold it to a European investor who asked me a very interesting question. Did I pay too much for this? I said, well, I'm the seller, you're the buyer. That's an interesting question. But the answer is not whether you paid too much for it, because time will tell, okay? The question is whether you paid more than you had to, and I'm not going to answer that question. So let's take a look at Japan, and I really captioned my presentation here, as brief as it is, as Consider Tokyo, because I don't think it's been considered for a while. And I think there are reasons to look at Tokyo, and certainly it's not because of the explosive growth that's going to take place in the Tokyo office market, not by any stretch of the imagination. But one of the things that we can see, and this is what this slide says, we've really come down in terms of global investment to two very distinct forms of investment, and one is risk averse. And I think that's become more important in the unsettled global economy that we exist in today. And not only that, because of the volatility in the market, there are also investors who are looking to take advantage of that. So we have very risk-averse and risk-embracing investors, And if we're talking to investors who may have an interest in Japan, specifically Tokyo, we're talking to risk-averse investors. There's not going to be, as I say, any explosive growth. This is going to be steady. I wouldn't want to go so far as to say that buying Tokyo properties is the equivalent of buying a bond, but it isn't that far off. And as we can see, even as of December last year, we looked at, and this to a certain extent I think comes away from the AFIRE survey, where opportunistic investing was the flavor of the month. Okay? And yet at the same time, and what surprised me too, is that core investors, in terms of what was most attractive to international investors, was low on the scale. That's only a year ago, and I think that that is starting to reverse. And you can see, even through this year, the amount of monies that have been raised up for opportunistic investment. While I'm a professor at NYU, I have decades and decades of experience in the industry, and my view from New York University, wallowing in real estate and also being in, and you can dispute this, the financial capital of the universe. I get to see the activities of the Goldmans and the Prudentials and so forth. And they did raise up an awful lot of opportunity and debt funds to invest in mezzanine, to originate mezzanine, and to buy non-performing loans and so forth. So there's certainly been opportunity money out there. But what intrigues me is some of these opportunity investors have reached a point where they are struggling to find investments, and we've even seen some of these funds return money to their investors because they didn't find the opportunities. Going back a couple of years, though, we're starting to see a movement towards core investors, and the core investors are now saying, where are those opportunities? And if you take a look around the globe and look at volatility, at least from my perception, as an American looking at the Eurozone and being very concerned as recently as within the last week or so, where the growth of the Eurozone has been downgraded a couple of times. I think on November the 9th, the Financial Times indicated that instead of the 1% that was being projected, growth in the Eurozone is now going to be 0.1%. And that's pretty sudden, and it's pretty extreme. The U.S. as a market for core investors has always been attractive. The usual suspects of Boston, New York, Washington have been priced back to the numbers that we've seen in 2007. So you're now back at 5 caps and 5.5 caps and so forth. So even for core investors, the fact of the matter is that maybe those markets, those CBD markets, have been really priced out of reach and are not going to be really necessarily large growth markets. So, and the U.S. is essentially a two-tier market. You've got East Coast, you've got West Coast, and what we refer to as flyover America, second and third tier cities. So, U.S. is attractive, but I think it might be at this point a little bit too expensive. China, as an investor, my concern, of course, is the opacity or the lack of dependable information. Maybe I don't want to pitch Japan as really something that is an investment opportunity by process of elimination. It stands on its own as a quality place for investment. So there might be increasing attraction of core markets, but as I mentioned, London, New York, Hong Kong, and so forth, I think themselves have gotten to be quite expensive, and Tokyo has not. And one of the reasons, again, is because Tokyo has really not been on anybody's investment screen. It's become somewhat overseen as a result of some of the dominant markets, particularly China. And so recently, we see a little bit of the rediscovery of Japan, specifically Tokyo, by a couple of well-publicized activities. AXA, it says here, has launched a Tokyo office fund, and that is entirely logical. As a matter of fact, last August in Tokyo, I met Mr. Ono, who operates out of Singapore for AXA, and made the observation that they are taking a very hard look at Tokyo, given what's going on right now. And in September, of course, the Tokyo market is outperforming the Hong Kong market, says Goldman Sachs, and so we're now starting to see Goldman paying attention to Tokyo as a logical place to put some money. And again, these are just headlines and they don't tell the whole story, but the Financial Times, the Wall Street Journal, IP Real Estate all take a look at Tokyo, not again by process of elimination, but for the quality that exists in the Tokyo market, and more importantly, the quality and the stability that exists in the Tokyo market. And this is my title slide, and it's true. Tokyo is not China, it's not Google, it's not Amazon, it's not one of these investment places that's hard to get your hand around. As I said, China lacks transparency and it's chock full of opacity. Google and Amazon are shooting stars. I suspect that you can make or lose money in an afternoon on these companies. And recently, and I'm going to have to make a comment here, but as you can see in some of the major economies, the only one that actually had a successful 2012 is Japan, and everybody was going sideways or going south. However, and if I were not to say that within the last week, there have been comments again in the Financial Times, in the Wall Street Journal, the New York Times, of a kind of a stunning announcement that there is a prediction that the Japanese economy will contract by something in the range of 3% over the next number of quarters. So if I were not to include that, I wouldn't be totally honest. One of the things that I will say is that there is a consensus among economists that while there will be this contraction, they anticipate that this is going to be short-lived, and that actually 2013 second half is going to be a period of recovery. We hope so. Again, going into GDP growth, and I guess I have to again include my little disclaimer or caveat that GDP growth in China, 7% means that it's slowing down. Would that the United States could say that 7% is slowing down. We're going to be at 2%. India, of course, is an explosive and rather chaotic market. They will have an increase in GDP. Australia is an interesting commodity-based economy, and you see Canada just below Japan. And of course, these economies are, in fact, really commodity-based. If you take a look at the cities that have driven the greatest return over the last couple of years, they are Calgary and Perth. These are not places where you're going to put your money, because each of these markets is basically a one-trick pony. We've seen commodity-based economies in the United States, whether they be Denver or Houston or New Orleans, and basing an economy on one product, even in New York, whether it be financial services, can be very dangerous. One of the things that you can certainly say about Tokyo, with a population in excess of 30 million and being a headquarters city for so many different industries, that they have a broad economic base and they are not dependent on any particular single or two or three different sectors of the economy. Yes, the population of Japan is declining. It's aging. That's not news, okay? And that will continue to be the case. I don't see that Japan has the luxury of, say, what the United States has, and that is we have what I refer to as a immigration spigot that we can turn on at any time, and we can enjoy as many immigrants as we want coming in. Japan doesn't have that ability or that luxury. But nonetheless, the important thing to keep in mind is that we're really talking about Tokyo, and we can talk about a decline in population in Japan for sure, but the interesting thing is that Tokyo has really a critical mass which almost creates gravity for the people of Japan. And so Tokyo will grow necessarily. And if I were a student getting out of university in Hiroshima, Sendai, or whatever, I'm going to go to Tokyo, and Tokyo will continue to expand. And there again, New York, of course, is expanding. We're having a little bit of a renaissance. Tokyo is expanding, and we're seeing other markets, Shanghai, of course, but for the most part, I think Tokyo, being the largest of these markets, is continuing to be an expanding market. And what is particularly interesting about Tokyo, and I make this point and have seen this for years, is the number of headquarters companies in Tokyo. One of the things I observed through the 1980s, and then when I joined a Japanese bank in 1990, and I'm trying to do a little bit of back of the envelope analysis as to what's going on. New York City in the 1970s lost tremendous number of headquarters companies that were in New York. We went from about 100 companies headquartered in New York to 70 to 60 or whatever, and now we've got 18. Okay, and what's that all about? One of the things that takes place in the United States is that we have an awful lot of options, and there is no stigma whatsoever for a U.S. headquartered company to be somewhere other than New York. In the 70s, when New York was going through some difficult times, in great part because of the OPEC embargo that quadrupled the cost of energy and turned New York into a very difficult market. Our infrastructure had been ill-treated or not maintained, and we had somewhat of a crime wave, and I observed that the cost of occupancy in New York was becoming very great. And by the cost of occupancy, I'm not only talking about how much it costs to rent space, but the quality of life, okay? The failed infrastructure, the increase in taxes, the graffiti on the subway. And corporations in New York said, we can't get quality workers, the educational system stinks, and we're leaving. We're going to Stanford, we're going to Atlanta, we're going to Boise, Idaho, we're going to Plano, Texas. And in the United States, you can do that. And yet that doesn't exist in Tokyo. If you are headquartered in Tokyo, you can't pick up and say, I'm going to Hiroshima, I'm going to Nagasaki, I'm going to Sendai, I'm even going to Osaka. So in a sense, there's almost something compelling about Tokyo that will make it an ongoing, serious, and important market for headquartered companies. So Tokyo has the largest number of headquarter companies of those listed on this screen, and I expect that to not only continue but also to grow. Again, we're talking about the growth of Tokyo, which might seem counterintuitive to what's happening in Japan, But once again, there has to be the ability to make the distinction between Japan and Tokyo. And Tokyo itself will continue to be a growing market and will continue to attract those innovative Japanese who want to be part of the mainstream of Japan economy. So, briefly, the overall market in Japan still has difficulties. And of course, who doesn't? I mean, after all, if we look around the world, Japan looks relatively peaceful and quiet compared to some of the other markets out there. And it is a unique world-class 24-hour city. That's not going to change. That's probably only going to increase. And again, relative to the U.S. and European and other East Asian markets, and it's something that I'm sure some of you are aware. It's gone unnoticed. I mean, even some of you, when you were invited here to hear about Japan, it was kind of a wake-up call. Gee, I'd never considered that. Okay, and that's too bad. As was mentioned, this is still the third largest economy. This is a country of 125, 126 million people. It's not going away, and it will continue to be a major economic capital in East Asia and in the world. But the difficulty, of course, of investing in Japan for foreigners, as is the case in investing in a new market for anybody, is to feel comfortable with your local partner. Okay, and Zymax has become a dynamic and powerful force, and yet they themselves really want to get their name out. I'm going to tell a story. Mr. Mori and Mr. Kawai can attest to this. I was in New York a few weeks ago, and I got a call from a reporter from the Wall Street Journal. I'm the guy at NYU who makes myself accessible, maybe too much so. But this reporter was directed to me through NYU's Public Relations Department because he wanted to talk to somebody who was knowledgeable about the Tokyo office market. So I was really delighted, and I got him on the phone, and I said, you want to write a story about the Tokyo office market? I said, you don't want to talk to me. So I gave them, I guess, Kawai, I gave them your name and number. I said, you should get off the phone right now, and you should call Mr. Kawai in Tokyo. Here's his contact information. They manage 500 buildings. Okay? And I went through a little bit about the market. I said, we have 2-year leases. It's a totally different system, and you really ought to talk to these people. That was great. And as a matter of fact, the Wall Street Journal did set up meetings in Tokyo with Zymax. And I was very pleased. I wanted to do what I could for Zymax. They have been very gracious to me. And sure enough, not long after that, the Wall Street Journal had a front page article on their business, on their finance sector, and it talked about Tokyo office buildings. Specifically, they were talking about buildings built under the more recent code, and these were addressing the earthquake risk of office buildings in Tokyo. And I was very proud until I read the article and saw that Zymax's name was not included in the article, whatever. And the name that was included was Mitsubishi Estate. And that's been a problem for Zymax, which is one of the things we want to remedy here today. But to a certain extent, it's part of an overall view where we want to talk to you about Tokyo and educate you, not that you're going to start throwing money at Tokyo today, but at least to begin the process of education. And so I thank you for your time, and I think from now on, for the rest of the morning, we can kind of drill down and get into specifics. So thank you very much.